The Department of Finance wants taxes raised, tax reductions delayed, and tax exemptions cancelled to reduce government deficits and debt accumulation. Presumptive President Ferdinand Marcos Jr. will assume office with a tight fiscal space as pandemic borrowings and weak revenues under President Rodrigo Duterte's administration led to debt reaching almost 13 trillion pesos. According to the DOF, the deferment of the personal income tax reduction scheduled in 2023, as specified by the Tax Reform for Acceleration and Inclusion or TRAIN law, would give the government 97.7 billion pesos per year. The DOF also proposes raising the value-added tax base and voiding exemptions to save 142.5 billion pesos. The agency says exemptions for education, agriculture, health, the financial sector, and raw food should be retained. But they recommend slapping excise taxes on motorcycles, single-use plastics, luxury goods, social media influencers, gaming, cryptocurrencies, and carbon tax. Bureau of the Treasury data show the Philippines needs to raise 249 billion pesos every year in incremental revenues for the next 10 years to pay the country's 3.2 trillion pesos in incremental debt. The Marcos family has an unpaid estate tax liability of 203 billion pesos after the Supreme Court ruling on the matter became final and executory in March 1999.